Betsy, the simple question is, what's this quarter about?
I think this quarter is about two things. One, showing that buybacks are accelerating, and two, showing that NII does have a forward path, does have an opportunity to go up as we look forward.
Betsy, is that this quarter or next quarter?
Some stocks you'll begin to see it this quarter, in particular in the consumer finance names that I cover, in particular on the card space. And of the big banks next week, we will begin to see that in their card portfolios. For overall, I think we're looking at, really a 2022 story here. But it feeds into some of the stuff that you've been discussing this morning, interest rates rising, and loan growth is accelerating. Mm-hmm. A lot of people push back on that, but it's happening.
Where is loan growth accelerating?
Number one is in card. We do have credit card in the U.S. right now running at about 2.5% up on a year-on-year basis. Look, a quarter ago that was shrinking. That is new news. There's a lot of debate as to how much of this is true revolvers versus transactors just spending more. But that'll be an interesting discussion that comes out next week. The C&I book, a lot of people are looking at, when are we going to get the commercial and industrial loan book to start growing again? And we've spent some time digging into this. It is already growing in services, in financials, in government. Where it has been shrinking is in the supply chain, utilities, energy. So when will that supply chain flip? We think we're beginning to see the signs of that, but just very nascently right now today. As PPP rolls off and we go into 2022, we think you'll see a sharp pickup in C&I lending.
Where am I going to get the biggest bang for my buck on buybacks? Which bank is going to deliver that?
So it's really in the card space where you've had a high level of capital coming into the pandemic and even higher now coming out, as well as reserve release still has a lot of reserve release to come through. So which name is that specifically? Synchrony Financial. Now, I know they don't report next week, but it's in the week following. We think that's going to be number one. The other big stock is going to be Wells Fargo. And Wells Fargo has a significant amount of excess capital. And as you know, they've got the asset cap. So they will be, also in the running there for biggest uptick Q on Q.
Betsy, back to the loan growth for just a second. What's the best way to play this inflection point that we're seeing consumer credit growth, sort of those loans now, and then you'll start to see the supply chain and industrial loans in early 2022? How do you play that?
So the way we're positioned right now today is we are overweight in our portfolio a little more towards the card names. Synchrony Financial, Capital One, American Express. As we move into next year, we do expect to see some pick back up in the C&I oriented stocks. Where I'm overweight today, with that kind of trade in mind, is Regions Financial. They have a bit of a skew to C&I, and importantly, they're not involved in a big deal, right? They've done some small acquisitions. Why do I care about that? They're boosting their C&I loan growth through these acquisitions. And I think they'll be sooner back to the table on buybacks than competitors that have been doing big deals, big depository deals, I should say.
Betsy, the market still feels top down rather than bottom up, particularly when it comes to the inflation story. The macro is driving a lot of things at the moment. How good a hedge are the stocks that you cover if we are going into a higher inflationary environment?
A very good hedge, I would argue. Look, the bank stocks should do very well in a rising interest rate environment. And importantly, I know the market's going to be beginning to discuss this question of what is good inflation versus bad inflation. Good inflation is when you can pass that higher input cost on to the buyer of your product. It's when your wages are going up faster than your daily necessity basket, cost of goods, for example.
Yep.
Our view right now today is that we're in a good inflation scenario, and that's a positive. It's a scenario that should bring rate hikes sooner rather than later. And it's a scenario where the borrowers are able to service their debt and, potentially even take on more.
Yeah.
So we're very positive on the banks for a variety of reasons, one of which we think loan growth is going to pick up, another one that the curve steepens. Those two things out of the four, drivers of earnings, those two things really haven't yet come through. We do expect that will be happening as we go through into 2022.
Hey, Betsy, broader macro question here. If you just take a look at the KBW Bank Index versus the S&P versus the 10-year yield, I mean, you've definitely seen the KBW outperform, not yet totally keeping pace with the 10-year. There may be a little bit more juice in there. If we just take into account the big guys going into next week, have they kind of topped out here? Have they maxed out on this sort of inflation/reflation steeper yield curve play?
That's not my opinion. We still have, some upside for the big stocks. We cover the megas, call it the B of A, Citi, JPs of the world. Out of those three, we're overweight Citi. We are currently underweight B of A and JP. It's really a function of their valuation being a bit more full than the rest of the group I cover. But there still is upside for the names. Now, importantly, what do we have in our outlook here? We've got 2 rate hikes in 23. And with all the talk of inflation, obviously the question on the table is, could that be more sooner? That would drive up my estimates, bring down the multiple, make it more attractive to own the stocks here, obviously. I think it's going to be really interesting to see what Jamie Dimon says on Wednesday, right? Because at our conference in June, he did a bit of a mic drop. He did a mark to market on the NII for the full year, given where rates were and the curve was. He hasn't really spoken publicly since then, well, at least, in a large forum on this topic. And I wonder, is he going to say that given this rate outlook that we'll end up having a bit of an uptick in net interest income as we look forward here?